Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 11th of December. I'm Daniel Lam, your host for the podcast. The US labor data release on last Friday would have disappointed a number of market participants. Many investors were looking for a weak number that would have justified the policy rate cuts that markets were pricing in for March 2024 and beyond. But in fact, it was a relatively strong print, with the unemployment rate falling from 3.9% to 3.7%, while non-farm payroll at 199,000 were roughly 15,000 more than expected. So what does that mean? Well, first of all, the FOMC is likely to pause in this week's rate decision. They would likely point towards the slowing inflation and private sector job creation, but they would need to observe further data in order to make any sort of commitments on the timing of future rate cuts. Now, SCB Global Research suspects that most FOMC members would want to see activity indicators more uniform and core PCE at or below 3% year-on-year before giving any concrete signs of future easing. Now, following this, what does this strong NFP print mean for future data? Well, in fact, incoming US macro data releases have been remarkably well correlated since last fall, which means that one large beat early in the month tends to presage further large beats in the ensuing 2 to 3 weeks. Now, in an environment where it was looking like good news is bad news, this non-farm payroll number could mean a less dovish environment in the very near term. Lastly, US macro surprise indicator is no longer biased towards the downside. Back in October this year, the US economic surprise index was hovering above 50. And because of the mean reverting tendencies in the index, it meant that it may head lower in the coming months. And so it did. It went to the range of 10 to 20. And that make further declines a little bit more difficult, and now especially so with the near-term data potentially getting stronger than expected. Now, of course, economic surprises drives yield. Positive surprise is likely to drive yield higher and may have a negative impact on equities. So this latest print may introduce some short-term volatility into risky assets. So at this stage, investors may need to check how the US 10-year Treasury yield move, especially if it may break above the 4.3% level, which was a previous support turned resistance level. If the yield fails to break above that level, then investors may continue to add to the long duration trades, i.e. long US large cap growth stocks, short US dollar, and long DM IG government bonds. But if it breaks above, then they may need to wait for better entry levels into these long duration trades. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.